So the next thing which I want to touch on, and this is more for you, building your own trading plan, okay? Above all, you need to have a firm belief in your trading plan. So there's a few ways you're going to actually be able to achieve this. Definitely backtest your own trading plan that you have, whether you want to use the free course, and backtest that, see how that comes out. But you need to have some backtesting, some certain type of experience with your trading plan to have that firm belief that, you know what, I can depend on this. I could literally, everything could go to shit, but I can depend on my trading plan to return profits to me. Okay, you need to understand your trading plan like you know your name, like you know your skin color, like you know. There's a lot of, like, you need to know it very, very firmly. Like, there's no way I should ask you what's your trading plan and you not be able to answer me, right? Because if I ask you what your name is, you're going to be able to tell me what your name is. You need to have a firm understanding for your trading plan and how all of this works, okay? So the next thing here is risk management. Risk management is the next most important thing after having the mindset in place. Maybe you're going to try to write this down. Okay. Your first and most important thing, background, remove that. Let's make this a little bit bigger. Okay, so your first and most important thing is having a proper mindset, having the winner's mentality. I'm taking notes on this. You guys should be taking notes on this too. Like, this is literally such an important information. And it's really up to the people to be able to take value from it. If you can't take value from it, then if you can't take value from a situation, this just ultimately tells you that you might need to work on your winner's mentality, because there's value in all situations. No matter if you're talking with someone for 5 minutes, there's something valuable, a thought, an idea, or something that you can pull out of this to capitalize on, okay? So you got to have the winner's mindset, right, for your trading plan. Let me do this. Trading plan. Okay, you need to have that mindset. Also, you just need to believe in your trading plan. You need to believe in your trading plan like you know your name, you know. You can't be switching up your trading plan every week just because you took a few losses. Like, you can't take a random approach. If you take a random approach with trading, you're going to get random results. Ultimately, you need to stay firm in your plan. You need to stay executing. It's like really just as simple as that, okay? So the next most important thing is risk management. Right? If you have no money to trade, you cannot make any money from the markets. Risk management. So you need, I would always say, risk at least 0.01 per $100 or more in the market. You know, keep your risk low, being able to capitalize on the opportunities that you will be presented with, right? And from there, we are you need to be able to do that. And another aspect to this, which is just going to be, so let's say risk 1 with the reward of 3+. Okay, so you can risk 1, or you can also be comfortable with risk 1 to gain 2, but this is something you just need to be comfortable with. If you want to risk 2 to gain 1, you can do that, but it's something you need to be comfortable with. If you are not comfortable while trading, you're going to be producing a lot of fears in the market. And one thing I want to touch on as well is the brain's ability to find patterns and things, okay? a lot of times if you have like a polka dot ceiling, you might be able to look at the ceiling and make images out and make a whole different type of thing. Here in North America, if you look at an outlet, so the things that you plug your fridge or your any like electricity things into, people say that looks like a smiley face, but ultimately it doesn't. Sure, it looks like that, but it's just the brain making patterns. So if I said, like recently I said, the pound Australian is going to increase. It's going to, I'm placing a long position on it basically. What a lot of people might do from that point is go onto their charts, scan every time frame and search for an opportunity. And why this is a bad thing is because the brain literally tries to make situations familiar. The brain tries to give us patterns that we're used to, something that we can take advantage of. And it might even see something that is not really there, okay? You're literally searching and searching for opportunities, but it's going to make you willing to take opportunities that are also not good, okay? So that's why it's also important to have the mindset in place, to have the firm belief in your trading plan. So no matter what anybody else says, no matter how many people might doubt you, oh, that can never work, or you need to switch it up like this and like this, as long as you're getting your desired results, you need to maintain and continue with that and not get sad and mad because you take a few losses, not to deter from your path because of the obstacles along the way. So the next thing would be time frame. And I would always say put 2 time frames in between. So you need 2 time frames, right? You need the trend. You call it the trend, and the second one would then be your entries. Okay, so and I would always put 2 time frames in between this. So let's go IE 1 week for trend. Okay, and then this also goes to, you can do the 4 hour or 1 hour entries, okay? So like the reason why we're putting a distance between the trend and the entry time frame is because, like I mentioned, there's going to be different market structure, different trends operating on all of the time frames, okay? You might have the weekly in a downtrend and you might have the 5 minute in an uptrend, okay? So we want to trade in the direction of the major time frame. Let me just add that. Trend is your friend. Trade in the direction of the major trend, okay? So if the weekly is on an uptrend, you're going to be on the 4 hour and the 1 hour, depending on what you want to do, and try to capitalize on these opportunities. Take the opportunities that go in the direction of the weekly time frame. Always just put 2 time frames in between so you can give it some space, basically some space to add up. If you would never want to use 1 time frame, for example, let's say the weekly is the trend and you also want to enter on the weekly, just because it doesn't give you any distance in between. It doesn't give you any room to capitalize on the minor moves of the market, okay? They don't have to be minor as small, but minor as in percentage, right? We can look at it as percentage. Okay, so the next really important thing here, I wish I could, let's do this. Okay, so the next really important thing here is, just a second. Nope. Okay, yeah. So the next most important thing with building your own trading plan is definitely going to be having a way to read the price. Okay. So I personally don't use indicators and stuff like that, but you can use them. Like I said, what you want to do in the market depends on your personality and your ability to work with that. So we're just going to write price reading. Okay, so I like to just use the candlesticks, right? Because the candlesticks are ultimately going to be the rawest form of indicators that you can get to. Green is up and red is down. Small candles have less activity in them. That's why they're really indecisive for what direction they want to go in. And then you just need to have some form of reading the price. So whether that's going to be that, candlesticks or moving averages, whether you want to use line charts, whether you want to use RSIs, stocks, what else is there? Trend lines. You need some idea of how you are going to determine what is buying worthy and what is selling worthy. And that's really as simple as that. As long as you can stay consistent with that, I wouldn't say adding a whole ton of these, because like you can look back and listen to it as well, why the market is random, because not everybody is going to be using all of these things at once. But I can depend on a lot of people using candlesticks, right? Just because candlesticks are very, very popular these days. Moving averages are popular as well, but they're popular as well. So the next thing here is some idea of support and resistance. So I'm just going to put SR, right? Support and resistance. You want to be identifying what is a low price and what is a high price. You want to buy low and sell high. So you can use the moving averages as well. What? You can use the moving averages as well to determine support and resistance. I don't cover that just because I don't really want to jump into all of that. It's not really important. It's not really it's not necessary to be using moving averages. So I don't really want to jump into how to use that as support and resistance. But like how I always show it here and from the free course as well, support and resistance, price is going to go through them, right? And where price fails to advance, it fails to advance for a reason. Who cares what the reason is? It fails to advance and it's going to pose as a psychological issue in the future. Let's go through and add some other ones. So we can also be using like the ones I use, which will be horizontal support and resistance. We can also be using trend lines, right, to identify what is a low price and what is a high price. That's what support and resistance ultimately is telling you. And then what else can we use for support and resistance? You could be using Bollinger Bands. Oh, crap. There's a whole bunch of different types of stuff. Have an idea for what is a low price and what is a high price. Next thing here would just be structure. So what kind of patterns are you trying to trade in the market? A lot of people want to do head and shoulders, want to be doing head and shoulders. A lot of people want to be doing engulfings. A lot of people want to be doing, what other patterns do you have? Like triangles. You have a whole different wide range of different types of patterns. All these patterns are, all the patterns have a random outcome. There's a very famous quote that says, a trader's job is identifying a pattern in the market and determining the risk of finding out whether that pattern will play itself out as it has in the future. Okay, so this is why risk management will also come into importance here. Being able to risk 1 to gain 3 on our trades. Just we see a pattern happen and we're like, okay, this is the floor area. I am going to risk $1 to gain 3 on this. This is why that type of thing is important. And the mindset on top of that is really, really important, because you might take 2 losses in a row and you're like, you know what, this doesn't work. Let me switch it up, which is not always the case. Okay. That's why you need the sample size to be able to get a better judgment on this. Okay. So you need the patterns. What patterns are you going to trade? Like me, if you want to just refer to the course, I'm only trading those 3. I'm only trading while I know the market is in one of those 3 states: the uptrend, the consolidation, or the downtrend. Okay. So next would be correlation, right? Understand that the market is correlated. So this just is correlation, strength versus weakness. Okay, so you buy what is strong and you sell what is weak. Let me try to show an example real quick. Let's go on a daily time frame. So here we can see once price came from this floor area, it increased. Let's go next time frame, it increased. 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 Let's go down to Euro Australian, and then this one should fall as well, right? We've fallen. If we go to the pound Australian, we didn't necessarily fall, so we can see that the pound is probably having some strength, right? And once we look at these pound pairs, we can see the pound is having some strength. So that causes consolidation within the pound Australian, because we can see the Australian was also rising, okay? I believe, yeah, those are all the pairs for those. So that's how correlation works. Buy the strong, sell the weak, and if you're trading 2 pairs that are somewhat equally strong or somewhat equally strength, whether that's going to be weakness, indecision, or strength, this pair is going to consolidate. You want to trade the weak against the strong and the strong against the weak. Don't trade 2 things that are near evenly matched, because those things they're near evenly matched. They're going to be a tie, right, in the long run. Okay, so the next thing here is have an idea for your stop loss, your entry, and your target. These things always have to be predefined before you can get into the market. Like, always have to be predefined before you can get into the market. I just need to find where I left these off, where I left that writing off. Crap. Yeah, so always have an idea for where you're getting into the market before you get in, whether that's going to be in the case of a winner, whether that's going to be in the case of a loser, okay? So this also goes into risking 1 to gain 3, risking 1 to gain 4, risking 1 to gain 5. This is a really simple and important concept to apply. A lot of people, I also see a lot of people who might be risking 1 to gain 1, and then the next time they're risking 5 to gain 2, or risking, it's not always the best idea to risk less to gain more. If I can just find where I left off this text, then that would be great. I think I can actually find it if I went, sorry, just a moment. Object tree. I don't know, I might have lost it. So pretty much always these things have to be predefined. If you go back into the free course, there is a page on the mental checklist. Literally, if you go through and just make sure you have that understood, that all of your trades can only end in one of four ways. Either it's going to be a small loss, break even, small win, or big win. No chance for small losses. Okay, let's go back in this and probably move it. Correlation. Okay, strength versus weakness. And SET, so have a stop, entry. Know where you're going to enter before the market actually, before the market closes. So you're like, okay, if I get a green candle at this support, then should be entering the market, and my stop loss will be below the floor, and my target will be the next take profit, the next resistance above. Okay. Always have these things predefined before you actually get into the market. Target. Okay. And a few other things. Next, really, really important. I don't know why people choose to overlook this. But at least the students that message me and tell me that they're actually using this, and they just tell me how useful it actually is. Okay. So have a journal, record the things. So record. I don't think I can really go into detail on this right now. I do want to start wrapping this up, but you can always record things like the dates. So the dates you enter, exit, and how you feel. How you feel is really, really important. How you feel about your trades. Do you realize you're starting to panic? Do you realize that you could have increased the risk more? And we're just going to include thoughts. Also include prices. Did anybody tell you to enter this position? Is this a signal? And make sure you include your risks, okay? And this will ultimately, at the end of trading week, you'll be able to look at this and see how you can improve on these and things just like this. Last but not least would be simple, okay? So after you have your trading journal, you start building more experience with this, you can then go through and remove any of the useless things. If you find that you don't need to be using trend lines, you don't need to be using Fibonacci, you don't need to be using fundamental analysis, whatever the case, just try to remove stuff. The more stuff that you can remove from your trading, the more independent you'll be able to be, because a lot of traders, let's say, use the moving averages. What if one day you wake up and moving averages is not, like, there's no longer a moving average calculator? So are you going to really start calculating the whole moving average thing by yourself? I mean, sure, there's a lot of traders who might go through and do that. But a lot of traders, I know at least 85% of traders are going to stop using it because they're not about the work. They're just not about it. That's really how that goes. You can use this to build a trading plan for yourself. The trading plan is going to be based on your personality, okay? The trading is such a free place where you can go through and choose to do whatever you want, but you also need to not take a random approach with it. You need to stay systematic. You need to apply some very common sense like ideas towards your trading and the concepts, risking one to gain more, having a statistical edge in the market. So maybe you're not taking trades all the time, but you're only taking trades during key support and resistance areas. Applying the time frame analysis, having a trend, a major time frame for the trend and lower time frame for your actual entries, having a way of reading the price, some way that you feel confident with, some way that you really feel that you can depend on this, because if you wake up one day and you don't think that your trading plan is going to work, do you think it's going to work? Because you're not gonna be willing to see the opportunities for the market and things like that. Like when I mentioned, your brain is trying to find patterns in things. So if I say go buy gold right now, and I don't really give you much other information, you're probably going to go on that chart and scan for a bunch of buying opportunities that fit your trading plan. And next, have a way to determine what is a low price and what is a high price. This is support and resistance. There are many ways, probably thousands and thousands of ways of determining a support and resistance. You really need to choose one and just work with it. And next is to have what patterns are you going to trade in the market? There are thousands and thousands of patterns as well. You don't need to use all of them. All patterns are also going to have a random outcome. So just try to keep it simple as possible. Correlation, don't sell strong stuff, don't buy weak stuff. SET, stop loss, entry, and target. Always know where you're getting into the market in case things go wrong for yourself. Always leave room for error. This goes back to the risk management, why we're risking 0.01 for every $100 or more in the account. Journal your trades so you can have something to look back at. Literally journal your trades to have something to look back at. And try to keep it as simple as possible. There's something called analysis paralysis. And pretty much if you have a ton of indicators on your chart and 7 of them tell you to buy, 12 of them tell you to sell, a lot of people are going to be caught up in the situation where they don't know what to do. They're like, maybe I'll just sit this one out, and we've discussed this and why you shouldn't really just be sitting out your trades because you don't feel like taking them. We're not applying biases to our trades. We're literally just trading your plan. You don't need to apply a bias. You don't need to be like, this one looks like this. I also want to talk about the reason why we're not going to say, this one doesn't look like a good trade, because I know a lot of traders have that experience where there might be trades that look completely terrible that still turn out to be really good winners, and you have trades that look really good that still turn out to be really, like, not bad losers, but trades that still look good and turn out to hit their stop loss, okay? So don't judge your trades based on their appearance. Just don't do that one. I want to start wrapping this up. If you guys have any questions that I can answer, be sure to just type it in there, and I will go through and answer your question.